Hey everyone, welcome back to Corporate Decoder, the place where we untangle the web of corporate filings. Today, we're diving into a Form 8K from CompoSecure, a company that, ironically, makes secure payment cards. This report is all about a spin-off, which is like a corporate divorce. We'll see if this split makes sense or if someone's getting the short end of the stick. Scroll date of report, date of earliest event reported. March 5, 2025/scroll. The big day was March 5, 2025, so this is when all the reported events went into effect. First things first, who is CompoSecure anyway? They specialize in high-end metal payment cards, think credit cards for the rich and famous. They also provide cryptocurrency storage solutions. Now let's get to the meat of the matter, the spin-off. CompoSecure has separated from Resolute Holdings Management, Inc. They're calling it the spin-off. It's like one company splitting into two independent entities. Let's see why they did this and if it was a good deal for shareholders. Scroll distribution. Data 12:01 a.m/scroll. This spin-off officially happened on February 28, 2025. CompoSecure distributed shares of Resolute Holdings to its own stockholders. Basically, if you own CompoSecure stock, you got some Resolute Holdings stock too. The people who own CompoSecure got a piece of Resolute Holdings. Think of it like getting a bonus dividend, but instead of cash, you get shares in a new company. Scroll each. Holder of record of CompoSecure common stock/scroll. The shareholders got one share of Resolute Holdings for every 12 shares of CompoSecure they already owned. So if you had a dozen CompoSecure shares, boom, one Resolute Holdings share appeared in your account. Resolute Holdings stock started trading under the ticker symbol RHLD. To make this spin-off happen, CompoSecure and Resolute Holdings signed a bunch of agreements. There was a separation and distribution agreement, which is like the divorce papers, outlining who gets what. They also signed a management agreement. CompoSecure Holding, LLC actually signed this one with Resolute Holdings, and this is where it gets interesting because it says that Resolute Holdings will be managing CompoSecure Holdings' day-to-day business. Wait, didn't they just split? Why would one manage the other? We'll dig into that. There was a U.S. state and local tax sharing agreement to coordinate state and local taxes. This is usually to reduce tax burdens and ensure that the split does not create adverse tax consequences in general. Finally, a letter agreement. We will see what that says in a bit. The separation and distribution agreement details how Resolute Holdings was separated from CompoSecure. This involved transferring assets and employees to Resolute Holdings, and Resolute Holdings taking on certain debts or responsibilities. Scroll employee. Matters/scroll. It also covered what happened to employee benefits and compensation plans. Usually the existing plans are split so each of the new companies can take care of their employees and their packages separately and distinctly. For employees holding stock options or restricted stock units, the report says that the number of shares was adjusted to keep the overall value the same before and after the spin-off. Essentially, if the spin-off caused the stock price to drop, they gave employees more shares to compensate. Scroll tax. Matters/scroll. This part ensures both companies know who is responsible for what when it comes to taxes, how to file them, and how to handle any disputes with the IRS. Scroll representations. In warranties/scroll. Here's the legal disclaimer. Neither company is making any promises about the assets or liabilities being transferred. It's all as is, where is. Scroll they. Spin-off/scroll. CompoSecure handed over all the Resolute Holdings shares to a distribution agent, who then gave them out to CompoSecure stockholders. After the split, both companies agreed to share information with each other when needed, especially for legal and regulatory compliance, as well as auditing purposes. Scroll release. Of claims/scroll. They both agreed to release each other from any lawsuits or claims related to events that happened before the spin-off. Now back to that management agreement. This is where it gets interesting. CompoSecure Holdings, CompoSecure's subsidiary, is paying Resolute Holdings to manage its day-to-day operations and strategy. This is not your typical spin-off. It looks like the company who span off is still very much controlling the company who did the spinning. Scroll Resolute. Holdings responsibility/scroll. Resolute Holdings will be in charge of things like setting objectives, overseeing management, planning capital allocation, managing acquisitions, and even communicating with investors. They're basically running the show. Scroll management. Fee/scroll. For this, CompoSecure Holdings pays Resolute Holdings a quarterly management fee equal to 2.5% of CompoSecure Holdings' adjusted EBITDA. EBITDA is a way to measure profits. So if the company does not profit much, Resolute Holdings may not get paid for that period. Scroll reimbursement of costs and expenses / scroll. On top of the fee, CompoSecure Holdings will cover Resolute Holdings costs and expenses. The management agreement lasts for 10 years and automatically renews unless someone terminates it. That's a long time. These companies are married for a while. If CompoSecure wants to end the agreement early, they could face a hefty termination fee. This fee could be equal to the fair market value of all future management fees, or 4 times the fees paid in the last 2 years. Getting back to the U.S. State and local tax sharing agreement, this dictates how they handle paying state and local taxes together and prevents either from abusing any tax benefits that they might be able to share. The letter agreement gives Resolute Holdings the power to approve issuances of CompoSecure stock for acquisitions and equity awards. This further cements Resolute Holdings' control. There's also some news about leadership changes. Roger Fradin resigned from CompoSecure's board of directors. In connection with Mr. Fradin's resignation, CompoSecure will hire Fradin Consulting LCC. That firm will provide advisory services to the board. In return, the consulting firm will receive $50,000, plus awards in stock options that is worth $150,000 a year. Because of this resignation, the company and some major shareholders waived a rule that required 11 directors, dropping the number to 10. The unaudited pro forma financial information basically shows what CompoSecure's financials would have looked like if the spin-off had happened earlier. It provides estimates of revenue and profits with the new structure, but it's important to remember these are just estimates. These pro forma financials provide us with key figures following the spin-off. The pro forma net revenue stands at $294.5 million, and after all the expenses, the company is left with $20.5 million. These numbers give us a snapshot of how the financials are aligned after the business split. So what's the story here? On the surface, this looks like a spin-off, but the management agreement raises some eyebrows. Why would CompoSecure pay Resolute Holdings to manage its operations after supposedly separating? Here's my take. It seems like CompoSecure wanted to unlock value by creating a separate entity, Resolute Holdings, but didn't want to fully relinquish control. The management agreement allows them to keep a tight grip on CompoSecure's operations, while potentially benefiting from a higher valuation for Resolute Holdings. This could be a smart move if Resolute Holdings has expertise that CompoSecure needs. Or it could be a way for insiders to extract fees from CompoSecure through the management agreement. It really depends on how well Resolute Holdings performs and whether the fees are justified. One risk here is the termination fee. If CompoSecure wants to get out of the management agreement, it could cost them a fortune. This gives Resolute Holdings a lot of leverage. Another thing to keep in mind is that all of this could have complicated tax implications for both companies and shareholders. The U.S. State and local tax sharing agreement attempts to address this, but tax matters are never simple. Overall, this spin-off is more complex than it appears. While it might create value for shareholders, it also raises questions about control and potential conflicts of interest. Investors should carefully consider the terms of the management agreement and the potential risks before making any decisions. Thanks for watching. If you found this corporate decoder breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate filings. What do you think of this spin-off structure? Let me know in the comments below.